Hey folks, Dan Frio here, the rate update. Today we're going to talk to those out there that are in forbearance, or if you know somebody in forbearance, please share this video with them. We can take maybe a lot of hardship off of some people, lift that burden from them this weekend and let them enjoy life a little bit more. So pay attention to the video. If you're in forbearance or if you're not in forbearance and you know somebody that is, please share the video with them. I'd truly appreciate that. We'll be right back. Okay, those out there that are in forbearance, you understand what I'm saying, but let me go through, let's go over three sections here. Let's go over what exactly is forbearance. That's number one. What options does the CFPB allow or grant you or kind of put in place? And what the CFPB is, just think that they're your protection agency in regards to all financial institutions. Okay, so we're going to give you what they're saying your options are, and there's mainly four of them. But there's not just four, there's many more. And one of the options that I don't like is modifications, and I'm going to talk about that afterwards. Then the third part of this video is going to be me explaining your exit strategies, who is in a sweet spot to refinance possibly to get yourself out of this mess. And then for those other ones, I'll explain your options on how to get out of it or what you need to say to your servicer to get some assistance from them. So first off, let's find out what exactly is forbearance.
If you are experiencing difficulty making on-time mortgage payments due to the national coronavirus emergency, forbearance may be an option for you. Forbearance can help consumers get back on their feet during short-term financial difficulty. But there are a few things you need to know and some important decisions you'll need to make. Forbearance is when your mortgage servicer, that's the company that sends your mortgage statement and manages your loan, or lender, allows you to pause or reduce your payments for a limited period of time. Forbearance does not erase what you owe. You will have to repay any missed or reduced payments in the future. So, if you are able to keep up with your payments, keep making them. The types of forbearance available vary by loan type. If your mortgage is backed by the federal government, this includes FHA, VA, USDA, Fannie Mae, and Freddie Mac loans. Provisions of the recently enacted CARES Act allow you to temporarily suspend payments if you are experiencing financial difficulty due to the impact of the coronavirus on your finances. Loan servicers may also have forbearance or deferment options for non-government backed or private loans, but the exact options available to you may differ. Here's how this works for federally backed mortgages under the CARES Act. If you are experiencing financial hardship due to the coronavirus pandemic, you have a right to request forbearance for up to 180 days. You also have the right to request an extension for up to an additional 180 days. But you must contact your loan servicer to request this forbearance. There won't be any additional fees, penalties, or interest added to your account, but your regular interest will still accrue. Other than telling your servicer that you have a pandemic-related financial hardship, you won't need to submit additional documentation to qualify for this forbearance. It's important to find out what options are available to you. The best place to find that information is from your loan servicer. Look for their contact info on your monthly mortgage statement. Right now, most financial institutions, including mortgage servicers, are experiencing high call volumes, so there may be long wait times to talk to someone on the phone. Regardless of the type of mortgage you have or how you communicate with your servicer, here are some things to consider. If you cannot make your mortgage payments and you are looking to suspend or reduce your payments, you will need to work with your servicer. If you decide to move forward with a forbearance plan, ask your servicer how you will be required to pay back the amount owed after the forbearance period. Will you owe the entire unpaid amount in a lump sum once the pause period has ended, or at the end of the loan term? Can the loan term be extended so that missed payments are added to the end of your mortgage? Will your subsequent monthly payments be higher for a period of time to make up the deferred amount? Finally, be on the lookout for scams and scammers looking to take advantage of consumers affected by coronavirus. You might receive fraudulent calls, emails, text messages, or other offers to help you reduce or stop your mortgage payments. Make sure you are working directly with your mortgage servicer. For more in-depth information, including information on how to find a HUD-approved housing counselor, go to consumerfinance.gov.
So if you're in a forbearance, you get it, but a lot of people don't. And that's why I tried to explain exactly, or have the CFP explain exactly to you what forbearance is. Now that a lot of people are coming out of forbearance, there's still probably about 1 million people, 1.2 million people in forbearance. But a lot of people are coming out of forbearance. So what does the CFPB have to say about your options? Pay attention to this, and when we come back, I'm going to give you my options and all the options that you have available to you.
There are a number of options for repaying forbearance, but which options are available to you may depend on who owns or backs your mortgage servicer, and your particular situation. There's no one-size-fits-all for options. For instance, if you have a federally backed mortgage, which is a loan from Fannie Mae, Freddie Mac, FHA, VA, or USDA, your servicer cannot require you to pay back your forbearance as a lump sum. Many servicers for non-federally backed mortgages also do not require lump sum repayments, but some may. So if you only hear about a lump sum repayment, ask about other options. There are 4 common ways to repay the money due from your forbearance. The first option is sometimes called a repayment plan. This can be a good option if you can make your regular mortgage payment plus some extra. It adds the amount unpaid during the forbearance to your regular monthly payments over a certain period of time. Let's say your servicer offers you a forbearance where you can pause your mortgage payments for 3 months, and your regular mortgage payment is $1,000 each month. So the payments you miss during your forbearance add up to $3,000. Suppose your servicer offers you 1 year to make up the $3,000 that was unpaid due to the forbearance. Doing the math, that comes to $250 added to your regular mortgage payment each month for 1 year. So your total mortgage payment would be $1,250 until you make up the skipped payments. After you've repaid the payments you skipped, your monthly payments would return to the normal $1,000. Another option is sometimes called payment deferral. That's when you wait to make up your unpaid forbearance amounts until the end of the term of your loan, or when you sell or refinance your home. This option can be useful if you can keep making your regular payment but can't pay any extra. If you receive a payment deferral, you don't need to make up the payments you were allowed to pause or reduce during forbearance until the end of your loan. At the end of the loan, your servicer may require you to repay the skipped payments all at once from the proceeds of the sale or through refinance. Let's say you sell your house in 10 years. In that case, you would pay off the forbearance then. Another option is sometimes called a loan modification. That's when you work with your servicer to change the terms of your loan to accommodate the missed forbearance payments. A modification might be right for you if you can no longer afford your regular mortgage payment because of a permanent change in your situation, such as long-term job loss. A loan modification would be, for example, if the servicer adds the missed payments to your entire loan balance, then recalculates your monthly payment, adjusting your loan term to bring your monthly payments to an affordable level. So instead of having 20 years until your mortgage is paid off, you might have 22 years to pay off your new loan balance. As you can see, your monthly payments may be lower, but it could take longer to pay off your loan, and you might have to pay more interest over the life of your loan. The final typical option is the lump sum payment. It's just how it sounds. As soon as your forbearance period ends, you repay all of your missed payments in one payment. So let's say your servicer offers you forbearance to pause your mortgage payment for 3 months. With a lump sum repayment agreement, in month 4, you pay your normal mortgage payment plus the payments you paused. So if your mortgage payment is $1,000 a month, in month 4, when your forbearance ends, you will pay $4,000. $1,000 for your normal monthly payment and $3,000 to repay the payments you skipped. After that, your monthly payment will go back to the normal amount. If you have the money to make the lump sum payment, this can be a simple option for getting back on track. However, many borrowers may not be able to afford the higher payment. If that's the case for you, ask your servicer about other options. Remember, if you have a federally backed mortgage, you will not be required to pay your forbearance payments back in the lump sum. Those are a lot of options, but not all may be available to you. It's important to work with your servicer to understand the process, consider your next steps, and understand the best option for your circumstance.
Okay, so that's great information, but there's a lot of ifs, whats, maybes, contact your servicer, and all this other stuff. I talked with people this week that were with PNC. You don't have an option. You have to make a lump sum payment. And the person, it was in the tune of close to $20,000. And we're helping that client right now. So let's go over your options that you have. And then I want to break down every loan type to just give you guys an idea on the options that you might have, and then my intake on this. So let's go through what they spoke about with the CFPB. So your forbearance options, the first one is a repayment plan. So let's break that down into what the young lady stated. So in this example, we're going to say that you have a $1,200 payment and you deferred yourself for 12 months. So you might have a smaller payment with a longer duration. You might have a longer or bigger payment with a longer duration or shorter duration, but most people were in the forbearance from 6 months to 18 months. So I took it in the middle at 1,200, and then I used it just a figure. I just pulled out a hat, $1,200. Okay, so this might be a little bit lower than your situation, but let's go through it. So the repayment plan, basically, the young lady stated, they would take your deferment balance. So in this case, it would be $14,000. You had a $1,200 payment, you deferred for 12 months, which leaves you $14,400. So she said, well, if you want to make payments on that, what they would do is your servicer can provide you up to 12 months of an adjustment to your payment to bring yourself current. So let me explain that. If they come back to you and said, okay, we'll allow you to catch up in 3 months, what you would have to do is you'd have to make your current mortgage payment the normal one. Then you'd have to start adding $4,800 a month to that payment to get yourself caught up. Okay. If your servicer then says, you know what, we'll give you 6 months, you'll be like, whew, okay, thanks. Well, you're going to have to make your current mortgage payment, your standard one or the normal one. And you'd also have to add $2,400 a month on top of it to bring yourself current. Well, if it's Christmas time and they want to be really nice to you, they'd say, okay, we'll give you 12 months to recover. And you make your normal mortgage payments and add $1,200 a month to that. And then after that duration of time, you'll be current. Congratulations. Okay. So that's the breakdown of option one. Option two is a deferral. What they do is they basically take the balance that you owe and throw it all the way to the end, and you worry about that 20, 30 years from now. So not a bad option. Okay. But I would definitely get the terms. The next one was modifications. And when I hear the word modification, the hair on the back of my neck stands up because I experienced this, and I was in the business in 2008, 9, 10, 11, 12, when all the mortgage company says, you know what, just send us your information in and we'll help you modify your loan. Probably half of those modifications ended up in foreclosure. The other half, probably 25% of those, ended up in complete frustrations, and people might have ended up in foreclosure. And it was a train wreck. What I saw the most standard concept was in the modification process was they would take all the money that you owed, and they would basically try to rewrite your entire note. Okay. So what they did in a lot of the ones I saw, they would take your current balance plus your deficiency balance, add it into one big loan, increase your rate because they're just trying to help you. Okay, that's sarcasm. And they would put you on a 40-year payment. Well, let's say you were in the loan for 5, 6, 8 years. And just by putting you on a 40-year payment, even with the deferred balance, your payment would still go down, okay, because now it's 40 years. So to help themselves, though, they would actually increase your rate. They wouldn't really emphasize that. They would just go back to you and say, you know what, we're helping you out. We're going to drop your payment $100, allow you to skip 1 month, and you can just keep making your mortgage payment after that. But sign these papers, not realizing that your rate went up and your term went to a 40-year term. So be very careful. I warned you. Okay, and then the lump sum. The only word that comes to my mind on that is yikes. You know, if you've been in through this debacle this whole time, you probably don't have $14,000 or up to $20,000 to dump as a lump sum. Okay, so that's the options that they're giving you. So now let me give you my take on all this. The first thing I want to do is go over with you this. All right, what this is this is the options that you have available with particular kind of loans that are out there. So they mentioned, you know, if you're, you know, how that can help you. So what I want to do is basically break this down to say, you know, based on the loan type that you have, what options would you have to possibly refinance? Does it make sense? How hard is it to do that? So I'll try to blow this up without distorting it. But probably the hardest loan to do would be a conventional loan. And I'll explain why. Conventional loan, you would have to come out of the forbearance period and then make 3 consecutive payments, cannot be made at one time. So let's say you come out of forbearance right now, you'd have to make November, December, and January's payment. Then you could possibly qualify for a refinance. Okay, so that's the conventional piece. So if you have a Fannie Mae, Freddie Mac, if you don't understand all this, please, I'm going to show you at the end how you can get a hold of me to answer all these questions for you. FHA is a little bit easier to say, but it's not as much easier. You can go in and you can do an FHA refinance, and you can basically start that process right now, and it'll take us about 30 days to get you done, and then you can get that loan refinanced. The easiest program to do is VA. If you're in a VA loan and you were in a forbearance, please call us. What we do is we'll do what's called a VA IRRL, which is IRRRL. Basically, it's saying, well, you made your payments prior to the forbearance. You didn't miss any payments for 12 months or 6 months if that's all you had the mortgage for. And now you're out of forbearance. So now what we could do is we can do a refinance. We can add in we'll take your current balance plus all your deferred payments or forbeared payments, throw that into a new loan, and redo that loan with you. The nice thing here is there's no appraisal needed. There's no income verifications. Okay, so that's that one. And then USDA is very similar to FHA. They require that you make 3 payments once you come out of forbearance. And then at that point, we can help you refinance. So again, these are the options that you have in regards to all of these categories. What I do want to explain to you, I get it, it's confusing. So if you're in a forbearance and you want to know your options, what I ask you to do is please go to my website, and that website is therateupdate.com. And it's going to take you right here. And what you'll do is give us a phone call, 844-775-LOAN. That's 844-775-5626, or schedule a meeting. You're going to click here. You're going to pick the day and time that we have available. And please, if I would ask you to do this, do it by a Zoom call if you can. If you cannot, please put in your cell number. We'd be more than happy to reach out to you that way. But if you do it by Zoom, we can look over your mortgage statements, any paperwork that you have from your current servicer, and we can help guide you through this entire process. So that's my video for today, guys. I greatly appreciate you guys watching. If there's any videos that you want me to discuss in more detail, please make sure to put that in the description below. You can always email me. That number or that email address is also down below in the description. I would love to hear from you guys. So God bless, guys. Have a safe Halloween. Have a great weekend. Take care. Please don't forget to give me a thumbs up. Subscribe down below. Hit the bell every time I post a video. You get an alert. I'll see you guys on Monday. Take care.